It's 10 a.m. right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channel Television. I'm Ladi Williams. Let's take a look at oil prices now. We see it dropped in early trade, extending losses from the previous day as Ukraine and Russia headed for peace talks, and on fears of a drop in fuel demand in China after the financial hub of Shanghai shut down to curb a surge in COVID-19 cases. Brent crude futures were trading down $1.18, about $111.30 a barrel, having dipped as low as $109.97. U.S. West Texas Intermediate crude futures hit a low of $103.46 in an early trade. And we're down about $1.09. Both benchmark contracts lost around 7% on Monday. Ukraine and Russia were set to meet in Istanbul on Tuesday for their first peace talks in over 2 weeks. Sanctions imposed on Russia after it invaded Ukraine have curtailed oil supply, and earlier this month sent prices to 14-year highs. We're going to drill down on this on the commodities market update. And back here, Nigeria's tax to GDP ratio is projected to increase to 15% by 2023, up from the current 8%. And this is according to the chairman of the Federal Inland Revenue Service, Mr. Mohammed Nami. Speaking with reporters after a road walk to mark the 2022 Taxation Week in Abuja, Mr. Nami explains that the projection is in line with the implementation of the Finance Act, which proposes an increase in some taxes to meet up with the nation's revenue deficits. Take a listen.
What Finance Act has done is to identify loopholes in our tax administration system, in the tax laws, in the entire tax system, and provisions are done, or relevant amendments are done on annual basis to block those leakages. So the result that you are seeing, that the tax to GDP moved from 6 to 8%, is a testament to the fact that those reforms that are being initiated and being implemented through Finance Bill, Annual Finance Act, is already working. So what we intend to do this year is that we are going to suggest more practical based reforms through the Finance Act, so that before end of the year 2023, we have a tax ratio to GDP that will be as high as 12 to 15%.
And in our first conversation, we're looking at Nigeria's transport sector with the National Transport Commission Bill, which seeks to provide a regulatory body and law for the sector. The Transport Trade Group of Abuja Chamber of Commerce and Industry say that there's this stagnation in the sector because of the delay in finalization of the National Transport Commission Bill. We have Mr. Olawale Rashid, Chief Executive Officer of African Railway Consulting and Executive Director of National Chamber Policy Center of NACIMA. He joins us now right there in Abuja. Great to have you. Good morning.
Yeah, good morning. Thanks for having me.
Right. So, first of all, help us understand the essence of this bill.
Yeah, the Transport Commission Bill seeks to actually provide a regulatory framework for the transport sector, which presently we don't have, and it seeks to provide a competitive basis for stakeholders and operators within the system. It provides for a commission, National Transport Commission, which is to be like NICOM is to the insurance sector, like PENCOM is to pension fund, and something like a regulatory framework. And this bill was introduced in 2013. It was passed by the two chambers in 2018, but presidential assent was withheld, and for some reasons, I think around 4 reasons. But what stakeholders are saying is that we need that bill to come on stream, because that sector, the transport sector, remains virtually the only sector without a clear regulatory framework, because this is already affecting investment in the sector, standardization in the sector, and sustainability of the sector. So the Transport Commission Bill is actually a bill that is very well needed now more than ever, and stakeholders are calling on the presidency and on President Muhammadu Buhari specifically to assent to it, to assent to make it become a law before we end this tenure in 2023.
Right, but how does this, commission complement other, regulators with, some other transport sectors like the air transport and the other transport sectors that we have?
Now, the standard practice is actually to have a regulator for the transport sector. So you are supposed to have what they call executive commissioners. Commissioners for aviation, for rail, for road, and for marine, and for road too. Now, each of these commissioners will actually be heading a full department, which is a regulatory department. It has no impact as such. The only impact is that the present regulators in the aviation sector will now transform to become a commissioner, an executive commissioner, under the Transport Commission. And it will still be performing the same function. They will still retain all their normal departments. As at now, the railway has no regulator. NRC is both the operator and the regulator. So that's executive commissioner for rail will now be in charge of regulation, heading a full department. The same thing will happen to port, and the same thing will happen to road. As to marine transport, safety issues will be out, and that's one of the contention why the president withheld assent for the bill. But I don't think it will have much impact, except that the commission will now subsume some other existing agencies in terms of their functions and activities.
So do you think, the president should still, assent to this bill, even though, he's raised, some of those concerns? Do you think it works that way?
Yes, it works because, one, that sector, the transport sector, remains about the only sector without a regulatory framework. And because of that lack of regulatory framework, it's affecting a whole lot of things. Can you imagine what is happening in the railway sector? How can NRC be the regulator, the operator? The road sector has no regulator as at now. The impressive development we have in the telecom is mostly associated with the fact that you have NCC actually regulating, providing competitive environment for operators and stakeholders within the system. So we think, and stakeholders at our roundtable also submitted that the president should sign the bill. We can now go further, just like what we did for the Electoral Act. We can submit subsequent amendments to that bill. In fact, the concerns raised by the president are simply issues that can be handled after signing it into law. And if we fail to sign it into law now, and 2023 knocks on the door, and what we have is that the bill will go back to square one. You now have to start all over again. And the bill that was introduced in 2013, is it not high time we have it into a law? We can now start amending any controversial sections that we thought should be amended. And we need this more urgently now. We need investment in the transport sector. Investment will not come if there is no regulatory framework.
Right, quite a long time there since 2013. But you're asking for a road corridor development agenda to transform roads and associated area into economy zones for sustainability. How is that supposed to work?
Yes, at our roundtable, we call stakeholders across the road sector, and the conclusion is that as at now, we are all in agreement that the road sector is in crisis. Underfunding, underinvestment, bad road. We are largely at the bottom when it comes to statistics on road safety, road wellness, and others. So the thinking is that we should not just focus on road construction. We should now move beyond just road construction. We should apply corridor development. And corridor development will actually cover things like, why do you need this particular road? Who are the expected users? What type of cars and vehicles will pass over it? What is this business model, sustainability model? These are some of the things the corridor philosophy we work on. And why stakeholders are calling for this is that as at now, we have underinvestment. We want investment in the road sector. Government alone cannot handle it. We already have 12 corridors already spelled out by the federal government. But we need a policy. And again, the policy has been in the making in the last 5 years. It has not been consummated. So the stakeholders were of the view that it is high time that policy is approved, is concluded, because this will help the road sector in terms of investment and sustainability.
Yeah, quite a number of recommendations there. But what other recommendations can you tell us, came from the roundtable you had on Friday?
A lot of recommendations. The first one is that stakeholders agree that, and they call on the president to sign the National Transport Commission bill into law. Secondly, they call for conclusion of the road corridor policy, that it should be concluded quickly and put it into operation. The third one is issue of multimodal policy. In other words, road cannot exist alone, rail cannot exist alone, aviation cannot exist alone. There should be complementarity, and there should be a policy guiding and regulating this. This will come, of course, under the National Transport Commission that we earlier talked about. So the stakeholders are actually calling for a lot of things, and we have sent the recommendations to the relevant ministries and agencies.
Right, and you talk about government not able to actually fund most of these investments, on its own. But how can the private sector, come in and actually bring in investments, into this sector and actually, make some profit, because they're not coming in there for nothing?
Yes, I think one of the proposals is that there is a need to deepen the PPP arrangement in that sector. You need to bring in the private sector. There is a model for it. The Infrastructure Concessioning Commission is working on that. There's a need to expand the tax for road construction initiative. The one we have, Dangote has taken up. We need other sectors, other players to come in. We need to deepen that line. We also need to conclude the road fund bill. That will also help. It's also still in the making in the National Assembly. There's also the need to explore what we call community ownership development initiatives. There are some communities that can actually take up road construction through their internal system. That is also in the pipeline. But overall, if you don't have the National Transport Commission bill operating, you can hardly have real investment in the road sector. Not just in the road sector, but also in aviation, in rail, in marine technology, marine transport. So we actually need to get the National Transport Commission bill up and running so that we can draw and encourage and facilitate investment into all the modes of transportation we have in the country.
Well, from your viewpoint, do you see, a private sector actually ready and, available to actually come in, to this sector?
The private sector is ready. The only constraint is that if you don't have a proper regulatory framework, nobody will want to bring in their money. So to bring in money into a sector, you need the law, the regulatory framework, and that's why the Transport Commission bill is necessary. If you sign it into law today, it will actually change the space. People will now see that their investment is safe, the environment is competitive, no monopoly will not be allowed or discouraged, will be moderated. And so, in effect, what we are saying is that you cannot get private sector in the real sense of it if the legal framework is not functioning well. And that's why stakeholders are calling for the president to sign that bill into law.
And what other implications are there if the law is not signed?
Yeah, if the law is not signed, one major implication is that the stagnation in the sector, in the transport sector, will continue. Rail transport is already in trouble. We cannot get the necessary funding. And this is also traceable to the legal framework. We are operating a 1958 Railway Act. All this will change if you have the National Transport Commission bill signed into law. It will also affect issue of road. As at now, there is high level of underinvestment. And to get money into the sector, you actually need a legal framework. You need a legal framework where your likely investors from foreign and local sources will be comfortable with their investment. So it has a lot of implications, and that is a negative for us if we don't drive private investment into that sector.
All right, for you now, Mr. Rashid, you know, we have quite a number of modes of transport, you know, like we have railway, maritime, but how do we, you know, realistically, you know, make all these modes of transport actually complement each other?
Yes, that is the question of multimodal policy we are talking about. It's also in the pipeline. The Ministry of Transport has been working on it. And when you say multimodal policy, you are thinking of seamless operation across the modes. That's marine, road, rail, and aviation. As of today, we don't have it. And unfortunately, road cannot operate in isolation. Rail cannot operate in isolation. The same thing with aviation and marine transport. So we actually need a multimodal policy. And again, this will take us back to the National Transport Commission. If you have the National Transport Commission, this is one of the issues that commission will take up quickly and urgently. And as of today, if you complete a road, fully completed, and you are now moving high freight load traffic on it, then the lifespan of that road will be what? Will be likely short-lived. But if you move high heavy load freight on rail, then you have a bit of complementarity. And if you move container directly from the shipping lines on the rail down to destination, to dry ports, whether Kaduna or wherever, you save the lifespan of your road, you reduce cost and mortality on the road. So there is a whole lot of things to gain by having complementarity. We need a multimodal policy. But again, that is the job of the National Transport Commission, which we don't have in place now. So we actually need to appeal, and that's the major appeal from private sector and from our stakeholders, that the president should, as a matter of legacy, sign the National Transport Commission bill into law. When you do that, what you have indirectly done is you have changed the face of transportation in the country. We know Mr. Fashola, Mr. Amici, and all of them are doing a lot in that sector, but it cannot come to fruition without having that bill into law.
Mr. Rashid, but, you know, what for you, you know, before I let you go, now, what for you are the major, you know, possible challenges to the successful implementation, you know, of this proposed bill?
Yes, there are complaints about some sections. Some of those sections include the issue of stabilization fund, that it was too high, freight stabilization fund, and some other things. But these are procedural issues that stakeholder thoughts can be handled when the bill is actually signed into law. You cannot have a perfect bill. In fact, a constitution is repeatedly amended and continuously amended. The same thing with any law. So there are challenges. The challenges will be, one, it will affect some existing agencies. And of course, people are scared. But why they need not be scared is that their interest is also already accommodated. Whoever is an executive commissioner now will likely be the present regulator in any of the modes. So we have challenges, but the challenges are small compared with the cost of not signing it into law. Just like what we have during the Electoral Act saga.
Right.
It was passed and signed into law, not because it's perfect, but because we need it. And the same thing in the case of the Transport Commission bill.
Yeah, as you say, Mr. Rashid,
there are challenges.
Yeah, quite a number of bills that, you know, have been signed. But, you know, what's the assurance that, you know, if this bill is actually, you know, signed into law, is going to make a difference, you know, for the transport sector?
Yeah, it will make a difference. From the rail perspective, you will now have a regulator for the rail sector. You don't have it now. Two, for the road sector, you don't have a regulator, you have a regulator. And what does a regulator do? Just like what NCC is doing, provide competitive environment for investors and for stakeholders. Presently, in the aviation sector, I think of all the modes, only aviation has a regulator, NCCA. The marine, the MPA is not a regulator. So we need an economic regulator for the transport sector. The contribution of the transport sector to GDP now is so low, it can be more, but it cannot be more if everything is so haphazard as it is now. For example, let me give you an instance. In the rail sector, we need investment. The Chinese funding is no more coming. Now, for it to come, for that funding to come, the regulator wants, the investor wants to see a change in NRC. They don't want a situation whereby we are operating a 1958 Act, which is what we are doing. So it has more advantages than disadvantages. And our plea and our prayer to the presidency is that the National Transport Commission bill should be signed into law.
All right, we'll be watching that, Mr. Olawale Rashid. The importance of a solid transport sector cannot be overemphasized. Mr. Olawale Rashid, the CEO of African Railway Consulting Limited, thank you so much for coming on Business Morning.
Thanks so much. Thanks for having me. Thanks.
All right, so after the break, we'll take a look at the commodities market. That's in a moment. To stay with us. This is Business Morning. Welcome back. So we saw oil prices actually taper this morning, and joining us is Lawrence Messi, analyst, financial derivatives company. Great to have you. Good morning.
Thank you for having me. I'm glad to be here.
Yeah, so it seems the oil bulls are losing steam here. They're the sentiment traders right now, and we're seeing there's not much action, happening there. Now we're seeing oil prices come down, but that's good for energy costs.
Well, yes, it's good for energy costs for, well, the subsistent part of the demographic. That's the households, people like you and I, basically. Well, in terms of revenue for Nigeria, what does that actually mean in the longer term? That's lower revenues for the government, lower avenue to implement capital-intensive projects. But before I even go further into this, I'd just like to give you some understanding as to why energy costs, specifically oil, is actually declining. Well, Shanghai has just implemented a new phase 2 lockdown. That's about 26 million people who will be restricted to movement. And China is actually the largest importer of crude oil. So just a bit of figures here. Their demand for crude oil is about 12 million barrels per day, and they only produce about 4. And so that's a deficit of about 7 million barrels per day, and that's met with imports. So with that lockdown of 26 million people, you can see that there is now lower effective demand, essentially. So the prices have to taper to account for that. And what does that now mean for all of us, basically? Well, lower crude oil price means lower energy prices. So the diesel surge we're seeing is going to come down. And
realistically, it's going to come down.
It should come down.
That would be great.
It should come down by expectation. And I mean, all the knock-on effects on housing, transportation, supply, logistics, it's going to ease up. But it's marginal, to be honest. It's still above $100 per barrel. But I guess it's a good sign for the average subsistent consumer.
So I'm guessing now, so what could actually, bring down the price of oil right now is demand, distortions, maybe some easing with geopolitical tension. Yeah. But if we see tension rise again, then we should see prices, oil prices actually go up.
Yeah, that's a very fair assumption, to be honest. If we want prices to come down, then demand has to come down. Maybe another full-scale lockdown, that's the only thing that will make prices come down, or an oversupply, to be honest. Countries are barely meeting their quotas. Some are not. Nigeria is not even meeting its own quota. So you can see that even with this quoted production, there's still a deficit because demand globally is already in a deficit with the OPEC quotas and all that. When countries are not even meeting these quotas, it's basically a recipe for price hikes, essentially.
Quite interesting. But what's your outlook, for oil prices, going forward?
That's well, I mean, we couldn't forecast that a war would happen. So, I mean, keeping all things constant, let's assume a stable resolution of this war. My outlook for oil prices would, I guess, it would be in the same trend. And my reason for this is because of energy companies are now beginning to divest in their oil exploration activities in order to maybe diversify into more sustainable energy needs. And as a result of that, we're not seeing a lot of production again. So we can see that the trend of oil prices will still be high above that $100 per barrel range, at least for the short to medium term. But it would be interesting to see what would happen in the African space specifically, especially due to its underdevelopment and now the new Dangote refinery that might be coming up. It will be interesting to see what's going to happen in Africa. But on a global scale, I think I expect oil prices to maybe start to moderate, but at marginal levels.
Right, and going over to the U.S. now, I see the Treasury bond yield is, showing us a sign. We're seeing a recession there in the U.S. in the making. Tell us more about that.
Yeah, it's not every day that you hear that the U.S. is going into a recession. So, well, earlier this month, the Federal Reserve actually increased their interest rates by about 0.25%. That's 25 basis points to curb inflation. So basically, there's something we call in economics called the transition mechanism. It's like a domino effect. One thing hits one and it hits the other and it goes on. So when you increase interest rates, your goal is to reduce the money in circulation. How that works is by increasing interest rates, the banks or other financial institutions increase the rate at which you can borrow money from the bank. And that means that you will not have access to financing for your new capital-intensive projects or your credit financing needs. And essentially, the economy is at like a standstill. I mean, we call it a steady state or equilibrium in economics. So when that happens, growth slows down. So because of what the Fed did by increasing interest rates, analysts are expecting that maybe the economy will slow down. And now to be more specific to the yields, the 5-30-year spread. So what it means is that the yields you get from a 5-year note and the yields you get from a 30-year note, the differential is what you call the spread. So normally, the longer dated notes should have more yields because it's into the future, because you're accounting for the inflation, the value of money, so it should have higher yields. But when the shorter dated instruments, that's the 5-year yield, is higher, then it means investors, institutional investors, retail investors expect that they need to get more value in the short term and forgo the value of the long term. And what that means is that you don't have a good outlook for the future, that you don't believe the economy will be strong in the future. And that's why it's a large indicator of a possible recession in the short to medium term.
Quite interesting. But what does a recession in the U.S. now, spell for emerging economies like Nigeria?
Well, a recession in the U.S., well, let's see. Let's try and paint a visual picture. Well, a recession in the U.S. will not be as bleak as we might see it to be because theoretically, a recession is basically a negative decline of GDP growth for 2 consecutive quarters. That negative decline does not necessarily mean that there's no jobs or there's no economic activity going on. But what it does mean is that interest rates over there may be a bit high. That's why there's not much economic activity. What that means is that because interest rates are high, investors will actually remove their money from emerging markets to invest in this higher interest rate environment. So what that means is we're going to see a bit of capital outflow from emerging markets. And because of capital outflow, then it means that countries like Nigeria will have lower foreign reserves. With lower foreign reserves, we're going to see maybe a bit of currency depreciation. And as you can see, there's going to be the exchange rate pass-through effect on inflation, higher costs, and so on and so forth. So that's what a recession in the US means for emerging markets. But like I said, it's all theoretical. To analyze the impact and the magnitude of what that would mean, we'll have to be at a more detailed analytical scale, but that's just the picture.
Quite interesting. And, you know, we've seen risk assets, you know, go up at this point, even though the Fed has, you know, hiked rates, you know, that's not going by the playbook at this point, you know. So, yeah, what do you think?
So for risk assets, to be honest, I guess it's just...
Bitcoin surging this morning, and NASDAQ and all the, you know, tech stocks all going up. It's quite unexpected.
It is, actually. I think 2022 has been, it's like quite conventional, but now it's anybody's guess. For the risk assets, I really believe it's more of just investors' play to kind of just sustain their value over a longer term, because as it says, risky assets lead to higher rewards, essentially. So people will try and remove, especially with geopolitical tensions, people will try and remove their investments from maybe government-dated bonds or instability, emerging economies that may be riddled with instability, so that they can try and focus on assets where their value can actually be measured based on core fundamentals, as you said, tech stocks. So the module, or the modus operandi, rather, of investing in risky assets is quite easy than government-dated bonds. Everyone is of the assumption that government-dated instruments are riskless because the government, in quotes, cannot fail, no matter which country it is. But companies can fail. That's why they're riskier. But still, with good fundamentals, they have the opportunity to give you a higher reward. And so that's why stock markets right now might be performing a lot better than government securities.
Right, and all eyes on Russia now. They have so many payments to make on their bonds, and to make sure that they actually make those payments. Anyway, let's look at some commodities now. We see South Africa's rice imports are expected to increase by about 3% to 1.1 million tons, and marginal growth in demand. What's stoking this?
Well, basically, if you actually look at the trend of South Africa's corn production, they've actually used lesser land. The amount of land they've used is actually it has halved over 40 years or so. But then it all paints the picture of efficient farming practices and also innovative farming techniques. So we're also seeing genetic improvements in seeds, which has actually contributed to South Africa's increased corn production. The assumption is that this year they will actually increase, as you said, by about 3% from about maybe, I think, about 15.1 million tons of corn to about maybe 15.6. So it's largely just due to these increased and improved processes in agriculture and farming. But we also need to look at the knock-on impact that this has had in terms of higher input costs and energy costs as well. But aside that, the net effect is that South Africa should, with their efficient practices, will increase their corn production.
Quite interesting, quite interesting. Let's bring it back here now. We see the Naira weakened in the parallel markets, 580. And we see some analysts are saying it's going to go even higher. What are you seeing?
I think last year I had a small conversation with some friends, and I actually did tell them that it could reach 600 as of December. That was because of the expectation that Christmas was going to fuel a lot of demand for Forex.
Right.
But well, it didn't reach 600, but now it's at 580. So the truth is, oil might be at 100, in excess of $100 per barrel, with the budgeted oil price at 60. But it doesn't stop the fact that, one, Nigeria is not meeting its quota. Two, Nigeria doesn't have as much local capacity to explore oil. It depends more on the foreign players in the market. And these foreign players are, like I said, divesting. I think 2-3 weeks ago, a friend actually just revealed to me that some international companies, Shell and Eni, had declared a force majeure. So I went to check it out, and I saw it on Bloomberg and other news outlets. Basically, force majeure just means that the companies cannot meet their obligations, again, because of circumstances out of their control. This could be due to insecurity, pipeline vandalism. So when they declare force majeure, basically if you have an agreement that I'm going to give the federal government 5 million barrels today, a force majeure just basically means I cannot meet that 5 million and it is due to circumstances out of my control. So we're seeing increased incidences of these force majeures or FMs happening in security. So this is largely going to reduce Nigeria's expected revenue inflow despite what the oil price is. And yes, I do expect that with that and without any diversified form of income, any sustainable diversified form of income, that the currency is likely to reach maybe 600 before quarter
Quite
three.
interesting.
It's
Quite
highly
interesting.
possible.
All right, let's look at domestic commodity price movements. Now, what's happening there?
Well, we haven't started to feel the effect of, well, the input cost, fertilizer cost, not yet anyway. And I guess that's good. At least Nigerians are not beginning to panic and there's not much need to start stocking up in view of higher prices. But in terms
Hopefully
of...
we have enough supply maybe to last us to the end of the year at least.
Yeah, hopefully. In terms of rice, I think there's been some production of local rice, to be honest. The only question is, will citizens patronize it? That's the question. Everyone, I think, is more inclined to demand foreign-produced rice, which is still at about 32,000 naira per 50 kg bag. The local bags reportedly are at about 25,000, so they're a bit cheaper, but the issue is the patronage. So in terms of corn, in the global space, we're seeing a kind of a split use now. There's a lot of demand now for corn for the use of ethanol, which is also eating into the supply of corn for just normal agriculture. So this multifaceted use of corn is kind of limiting the supply for just subsistent consumption. And this might lead to increase in prices, and this can only be met when countries like South Africa are increasing their production and subsequently their exports. But it's essential to look at the international community and where it's going. Everyone is really trying to go into protectionism and sustaining domestic supply. So it's not enough that countries are increasing production. Are they going to export this? And I think it would be good to look at international trends. But in terms of local production, I think the prices will remain a bit stable. In terms of logistics and transports, those issues still remain, and I don't think they've worsened over time, well, except the diesel price. But with all of these factors considered, I think you can expect that the price will actually be volatile, but within a certain band. It's too early actually to predict whether they will shoot up or come down. So you'd want to look at the marginal fluctuations week on week.
Quite interesting. And, we saw a couple of commodities hit, new highs, from nickel, aluminium, all of them soaring, and I'm wondering what's happening with those prices now. Are they also tapering, seeing what's happening with oil? Because they normally move with oil prices, if I'm correct.
Some of them do. Some of them depend more on supply shortages. But with the Black Sea area, that's around Ukraine and Russia, where a lot of trade actually goes on, it's been warded off due to the war. I think we're seeing shipping costs increase. We're seeing freight charges increase. And then we're still looking at pre-pandemic levels of demand that have still not been met by production, especially, as you said, for nickel, for smartphone devices, for chips, for conductors, all of that. So we're kind of seeing a stabilization of the price, but they are still above average, to be fair. Well, they are not rising as fast as they were last year, but they're still there. There's still shortage in the market, but I guess we'll just have to wait and see how raw materials can translate.
All right, I guess it's a wait-and-see moment. Lawrence Messi, analyst, financial derivatives company. It was great having you. Thank you so much for coming on the program.
Thank you.
All right, so we'll take a moment now. Business Morning returns in a moment. Do stay with us. All right, now let's take a look at what's happening in the markets. We have Ini right there. Hello, Ini.
Hi, Laddie. Good morning. Welcome to the Market Corner. Well, yesterday, as that's been for about 3 weeks now, the equities market started on a negative note. We see that There you go. The only red there was value, but most of this was profit taking. We saw a lot of activities, but mostly profit taking and fixed income. And then the market was down 0.15. But I would like to focus on the fixed income space. Yesterday, we tried to have that conversation, but we couldn't really do it. Today, we have Ramat Baba. She's a fixed income dealer with FBN Quest. Hello, Ramat. Good morning.
Hi, good morning. How are you doing?
I'm great. I'm great. So yesterday, I tried to have this conversation about the factor or the movement or the drive that the CRR is having on investors in the fixed income space. MPC was just about 2 weeks ago. Tell us, what is that doing in the area of liquidity in the fixed income space and investor sentiments at this time?
Okay, so typically the CRR, that's the cash reserve requirement, mostly takes funds liquidity out of the system, especially during periods where the system is very liquid. And the maintenance period is usually every week, starting from Thursday to Wednesday the next week. However, last week what we noticed was because the system was very illiquid, there was no liquidity in the system, so there was actually no CRR debit by the CBN. Also, given the system liquidity, last week we saw the activities reduce in the fixed income space. There wasn't a lot of buying in that space, so activities kind of slowed down.
So how do we explain that? If there's a lot of liquidity in the system, we should see investors trying to, get into different auctions and make the most of the investment opportunities.
Yes, so like I mentioned earlier, last week there wasn't a lot of liquidity in the system, but going into Friday, last week we saw federal allocation was paid and about 280 billion came into the system and market became awash with liquidity. Following that, we saw in the local currency Naira market, we saw interbank trading at 4.5% for overnight placement, and that has been that's the same thing it was yesterday. And then yesterday we also saw coupon payments coming into the system on the 2035 and 2050 bond of about 136 billion. We actually expect a bit of activity to start coming into the market again as the system is awash with liquidity. And also given the fact that there's going to be another CRR debit this Friday. And since market is liquid, we actually expect the CBN to soak up some liquidity through CRR. So we might see a bit of people try to invest their funds as against having them idle and exposing them to CRR debit. So we might begin to see some activities in the market again this week.
Yeah, exactly, Ramat. We'll surely look forward to more activities there since there's more liquidity in the market. Now, thank you so much, Ramat Baba, fixed income dealer with FBN Quest. Enjoy the rest of your day.
Okay, bye.
So, Ladi, that's it. We expect better reports from the fixed income space, not necessarily from the equities.
Exactly, but I'll be watching out for the equities close today. Thank you so much, Ini.
Thank you for having me.
All right, now let's head on to London. We have Juliana standing by. Great to have you, Juliana. Good morning. So let's look at what's happening with retail. We see Deliveroo back in the news. They've struck a partnership with W.H. Smith. What are you hearing about this?
Yes, that's right. Good morning, Laddie. The online delivery operator has just this morning announced a trial partnership with a W.H. Smith, which is a stationary retailer, and they've had a pretty difficult pandemic, of course, because they're most notable in airports and in railway stations. But alas, they teamed up with Deliveroo. So from today, customers will have an opportunity to get their hands on a best-selling book or a couple of pencils within 20 minutes. Now, this is going to be launched in Reading, which is a town just outside of London, and then over the course of the week, this trial will be expanded to stores in and outside of the capital. And obviously, we know that the online delivery market is pretty crowded, so Deliveroo are doing their absolute best to make sure they can offer as much merchandise to customers as possible. Just a couple of months ago, they also teamed up with Sainsbury's and Waitrose too. So if you are a Deliveroo customer, you can also get your groceries as well as some stationery.
Quite interesting. And we got an update for the P&O ferries. Pride of Kent, one of their ferries, got detained, after failing inspection. What does this mean for the company?
Well, yes, the embattled P&O ferries is currently in a pretty public spat most notably not just with the 800 seafarers that lost their jobs earlier this month, but also with the Transport Secretary Grant Shapps, who has, vowed to do whatever he can to kind of overturn this pretty hasty decision that was made. And part of this probe is by asking the Maritime and Coast Guard Agency to have a look at every single one of P&O ferries vessels to make sure that they're fit to look after passengers, and two have been deemed unfit. First of all, on Friday, we have the European Causeway vessel detained, and this was because the agency deemed that the new staff that are on about £5.50 an hour, well below the minimum wage here in the UK, were not trained enough to handle the vessel. So that was detained on Friday. And then today it is another ship, the Pride of Kent. They failed an inspection and it's been deemed unfit for service. So we are going to be expecting more of this in the coming days. As I said, there is new legislation that the government are trying to get through Parliament to make sure that seafarers are protected. And we know that Britain is a very small island nation. Seafarers are an important part of the workforce, and I think this is considered a reckoning in protecting their rights, which is why lots of these probes are happening at the moment.
Right, quite interesting. We'll keep tracking that story. Thank you so much, Juliana. Enjoy the rest of your day.
Thanks, Laddie.
All right, now let's take a look at more markets now. We see the crypto space still in the green with the fear greed index, showing sentiment in the crypto space now standing at 56 points, showing that it's greed. The market has been in extreme fear for quite a while now, but now we're seeing a greed creep into the market. Just looking at market cap, that $2.16 trillion is up by 1.96%, sitting pretty above the $2 trillion mark. Volume traded up about 20.75% in the total crypto space. Bitcoin dominance sits at 42% there. We see the price of Bitcoin this morning, $47,574, up by 1.41%. Volume traded, $34.90 billion. We see Bitcoin is remaining strong above the 45,500 resistance zone after starting a fresh increase to clear the 46,500 resistance. Now we see Ethereum there, $3,411. That's up 2.85%. Volume traded $19.91 billion. We see Ethereum also breaking a couple of resistance there at 3,250. Cleared that, and now above the $3,350 level as the price settled on the 100-hourly simple average. Let's look at the top alts by market cap. It's all green on that counter there. We see Cardano, the biggest mover on that counter. Let's bring in Rumi Ofi now, digital market analyst. Hello, Rumi. Good morning.
Good morning. It's green.
Yeah, it's really green, and I can see the excitement there from you, and most traders in that market quite excited right now. But I see more endorsements coming for Bitcoin. One is the Canadian Conservative Party candidate for Prime Minister. He's come out to say, you know what, let's allow all Canadians use Bitcoin as legal money in the country. That's quite interesting.
Yes, exactly. It means that people have actually seen the reason why they should give Canadians, this Canadian Conservative Party candidate is actually vying for Prime Minister. Canada has a history of the current Prime Minister getting involved with the protest, and it's been funded by crypto at some point, closing bank accounts and other those things. So this guy is saying that people should be given more financial freedom. And the truth is, the data are just coming out quite big, that an analysis done by IPOS found that about 25% of Canadian adults are considering using cryptocurrency in the future, right? So, and it's quite huge. Cointelegraph also did this in January about for about 1,000 people, and it shows that 62% will be getting involved or being paid with crypto by the year 2027. But notwithstanding, the market has been very, very, very strong. And I see that, I've been able to, I was telling you at some point that 35 was very significant. But what is happening in the market that people need to know is a function of demand and supply. So on-chain analysis from this platform, which I usually use, is called 1 year plus hurdle rate, suggesting that it has been tracked that on-spend transaction it's actually increasing. People are not spending their cryptocurrency, most especially Bitcoin. And when the percentage goes up, it means that a lot of people are having interest to hold. And a lot of persons were scared at some point. And it is, we have speculators and hodlers, right? So in the last couple of months from, the fear has been increasing. I know you have been frequent with the fear and greed index. So fears have actually stemmed from the U.S. Federal Reserve increasing interest rates, and also initiating quantitative tightening to curb inflation. That's also very, it's something that you need to get someone scared. Then the Russia and Ukraine war came in, Omicron virus came in, so all of these guys, a lot of people were scared. Even at some point, some of us were scared, but we know the data and we know our history always repeats itself. So some felt that the whales are going to sell, but what is most significant is that most of these whales, they didn't sell, they kept on buying at specific lows. It seems that the institutional investors are always looking for discount price. When the price is very low, they buy. Yeah, very, very low, they buy. And people that usually lose money in all of these things are people that wants to get gratification, and greed is not good in this industry. Thank you.
All right, Rumi. Thanks for that. Well, but talking about selling now, very quickly, when are you looking at taking profit?
I'm in for the long term. I have expectation in the next 10 years.
Diamond hands. All right, Rumi, always good to talk to you. Thank you so much.
Thank you.
All right, so that's it on the crypto market and Business Morning today. Thanks so much for watching. Don't forget to join us at 1:30 for Business Incorporated for more updates and developments in the world of business. Thank you for watching. I'm Ladi Williams. Bye-bye.